Recent report from Vanguard issues warning about your 401k balances for last year. I've got that report and whether it's a valid warning or not. I've got that and more coming up. My name is Mike Bernard. I'm the host of the Wise Money Show. I'm also one of the certified financial planners right here at Korhorn Financial Group. Make sure you hit that subscribe button, turn on notifications, and smash that thumbs up button. Your 401k, Kevin Korhorn, the founder of Korhorn Financial Group, one of the co-hosts on their weekly talk show that airs right here on this channel and on podcast, a few other places as well, has said your 401k for most people is your greatest wealth building tool. Very few people own businesses or whatever. So your 401k is, for most of us, your greatest wealth building tool where you can take a large amount of your income, defer tax on it, and kind of stash it and store it up for your future and help you build wealth. Therefore, the pace at which you're contributing and how your 401k is invested and structured and how it's growing over time is of significant importance. In fact, Kevin has also said that what's the most important decision in your financial life, and we spar over these. There's lots of foundational, unbelievably important financial decisions. It's not just one that will set you on the glide path, but he's even said it's your investment allocation. Early on, if you're too skittish or too concerned and you don't invest aggressively enough and you let it ride, that is going to have significant ramifications and consequences over your working career. Conversely, if you gamble or go risk on, risk off and make a lot of changes and reactions to what's going on in the headlines or what's going on in the markets, that will also have huge ramifications as well. He's not wrong. He's not wrong. And I especially say that right now. There's all sorts of studies for when folks are beginning their career or starting to invest, what's going on in the stock market at that time. Individuals that begin investing or start their career during bear markets or challenging times in the stock market are less likely to invest in the stock market for their financial future, and because they're less trusting of it. I understand that, but it's counterintuitive because those are the exact times when you should be investing. If you could pick back over the last 20 years, when was the perfect time to invest? When was the best time? 20 years ago. But then the other 2 points, or 3 points, if you will, the worst part of the dot-com bubble, the tech bubble, the worst part of 08 and the financial crisis, and at COVID, at the most extreme times. Like, those are the times when you should be investing. And, and typically, emotionally, people that start investing during those times are less trusting of it. I recently saw this article in this headline. You may have seen this as well. I saw it splashed over through a lot of different mediums, and that is a warning issued about average 401k balances last year. The average employer-sponsored plan last year, so average 401k plan last year, had a balance of $112,000 in it. And the warning was, this article and the report said, here's the warning. Well, the year before, 2021, that average was $141,000. So guys, big warning, it's gone from 141 to 112. And the article, and at least all of the articles and headlines that I saw about the same data from Vanguard, wasn't that, see, people, this continues to suggest that there's a retirement readiness gap. That's not the connection that they made. The connection that they made was it dropped significantly. Guys, to me, this is not a warning at all. If you do the math, and I'm a geek, if you do the math, that's about a 20% decline in the average 401k balance. Well, what did the stock market, how did the stock market perform last year? Yeah, down about 19%, 18% if you include dividends. But if you're diversified and you have international investments, small cap investments, you were down about 20%. If you had a lot in bonds, then maybe you were down a little bit less than that, but bonds were awful last year. Guys, the previous 18 months, and I know that the stock market has recovered a little bit recently with the debt ceiling passed and inflation calming and the Fed rate pause, and all of that is good news. Now we just need the economy to start growing again. But guys, the previous 18 months, they've been extraordinary times for investors. Going back 100 years, last year was the 7th worst year in those 100. Okay, now the majority of those 100 years, the stock market was up. Okay, but of the ones that were down, this was the 7th worst last year. This was the worst year in the bond market index since they started the bond market index about 50 years ago. And if you just overlay that and sort of extrapolate it out or extend the history of the bond market, I think it was one of the worst in the previous 100 years. And so guys, I would tell you, there are ups and downs in the stock market. There is risk, there is a relationship between risk and reward, but that's a feature of investing, that's not a bug. And the previous 18 months have been an extraordinarily challenging time for investors. Therefore, looking at the average 401k balance and seeing that it dropped 20%, essentially in line with the stock market, I would have expected that. And that shouldn't be a reason for alarm. That really should just be, it's going to happen like that, 1 out of every 4 or 5 years. And in fact, last year was pretty extraordinary. I would encourage you not to buy into the sensationalism and the wow, you should be concerned. Instead, I would have you do a few things. Number one, with your 401k, continue to invest aggressively towards your financial future. Second, make sure that 401k investment, but also your entire portfolio is invested in a risk tolerance within a few different strategies, but that make up a risk that's appropriate for your financial plan and specifically your retirement plan when you're going to need those dollars. 3, I would tell you that if in the moment when you get concerned or those time periods, at least once a year, we're going to see about a 14% drop in the market. On average, 1 out of every 4 years will be negative in the market. Focus on buying new shares, not what the value is of those shares. So look at the number of shares that you own, not the value of those shares. And then lastly, in those times when you do get concerned, be focused on the horizon. What's that horizon? Be working with your certified financial planner on that 5-factor retirement plan and ensure that you're on track. For many people, yes, the markets and their investments are down, but their retirement plan remains on track. And yes, if the stock market doesn't cooperate for a long period of time, that's going to cause some adjusting, but you're going to want to know that, right? And you're going to want to be aware, where do you stand in relation to your goals? Don't be alarmed that the average 401k balance over the last year did actually go down. Be focused on the horizon, make sure you're taking the right level of risk, and have the right investment strategies implemented for your specific situation. Work with your certified financial planner on that. If you don't have a CFP on your team, you can contact one on my team. Find us online, Korhorn.com. That's Korhorn with K, wisemoneyshow.com. You can find us there as well, or give us a call, 574-247-5898. All right, there you have it. Go out and take your next wise step in your financial life.